Okay, well, we'll get started here. Hello, everybody. Welcome to the New York City Accelerators Financing Energy Projects webinar. I'm Andrew Chintz. I'm the financing specialist at the New York City Accelerator. And first, I just want to thank all the panelists and the attendees for participating in this event. And just also want to note that we have quite a few people have registered, over 700 registrants, which is good to know. It sounds like we're apparently delivering the information that is needed. Some of you may recall that about a year ago, we did a two-part webinar series called Financing 101 to present the different types of financing options available to building owners in New York City to comply with local law 97 and generally decarbonize their buildings. And in fact, if anybody would like to view those, we will have those posted in the chat later. But just as context, today's webinar is kind of a follow-up to those previous events. What we're doing is we want to now showcase some of the initial financings that closed on some of those loan products that we talked about. So let me get started here. So just a quick on our agenda here, I'm going to just give an overview of the New York City Accelerator, and then we're going to spotlight these three different lenders and their loan products and the case studies that they have to share with us. Also want to note too that we will be doing another one of these, a part two, with other lenders and their closings and case studies. So stay tuned for that early next year. One other thing to note is that, as many of you probably know, we target, the accelerator targets primarily building owners. We're helping them giving them assistance to decarbonize their buildings and comply with local law 97. So what we have here is, along with the lenders, the building owners, the borrowers on these loans are joining the lenders, and they're going to share some of their experiences in obtaining the financing, so that, we hope that this will provide some additional insight for some of the building owners out there that are taking some similar pathways. So once we're done with these case studies, we'll open it up to everyone will all have questions, but you can feel free to drop your questions in the Q&A at any time. So first thing we just want to do here, a quick survey question with Slido. We just want to get a sense of who's out in the audience, and just to get a sense of, so that we can adjust our presentation to make it more relevant to you. So I'm going to, if you could just participate on this by using the QR code and this code, and then we'll just take a look quickly at what the results are. So we're seeing quite a few building owners. It's over or close to half, which is what is to be expected. And that's kind of how we've geared this to the building owner audience. Take another second here to look at this, but it looks like we're getting the basic composition of the audience. All right, well, great, thank you. So it's somewhat as we expected with building owners. I'll just go back to the slides here. Okay, so just a few minutes on Accelerator. What is the accelerator? We're a program. It's a free, customized technical services to help building owners decarbonize their buildings and comply with local law 97. The program is sponsored by the city through the Mayor's Office of Climate and Environmental Justice. So what we do is we help you with all aspects, trying to determine what you can do with your building to avoid the local law 97 penalties. We have a service provider network. We can connect you with various service providers that we've vetted. We can direct you to all the incentive programs. We have a map of over 70 different incentive programs. And also, of course, help you with financing. And we do some training as well. So the way it works is we work with any building that's over 5,000 square feet. If it is a smaller building, we do have other organizations that we can refer you to. And all you do is connect with us, and you will get a dedicated account manager. They'll be your point person, and the account manager can bring in some of our specialists, which includes financing or solar feasibility or high performance. So we have a lot of different resources. And again, it's all customized to your particular building. And again, it's all free service. So just on the financing aspect, so when you're working with your account manager and you want to finance the work you're planning, we would get involved and kind of understand the project, the building, the use of the building, and the size and the type of work you're going to do and what your financial structure is. And then we can sort of direct you to the most relevant or appropriate financing options. And so we would not only connect you, but kind of stay in the process and help you navigate through it, help you assess all your different options. We're kind of a trusted advisor, objective advisor. So, and I just want to put this webinar in a little bit more context. You know, many of you know we have New York City Accelerator PACE financing, which was authorized under Local Law 96. PACE is a great tool. It doesn't always fit for the types of buildings and projects and size of projects that we often are working with the building owners. So the Accelerator put out an RFQ for other financing, non-PACE financing options, and we have brought in and vetted 13 different capital providers, and they kind of fall into three categories: or specialty finance companies, or our CDFIs, or green banks, or nonprofit lenders. A CDFI is a community development financial institution. We also have an equipment lender group, and then we have our non-debt financing, which is our energy service agreement or as a service type providers. So today you're going to hear from three of our approved capital providers in their first their case studies. So I think next I'm going to introduce the first speaker. It's Dan Fielding, who's the Director of Strategic Partnerships for the Habitat New York City Community Fund, which is a Community Development Financial Institution, or CDFI, and it is affiliated with Habitat for Humanity. Dan's going to present the first loan that his organization completed in collaboration with the New York City Accelerator. And he's going to be joined by John Rivers, who represents the co-op that was the borrower. So I'll hand it over to Dan.
Thank you, Andrew. So as Andrew said, my name is Dan Fielding. I run the Habitat NYC Community Fund. We are a wholly owned subsidiary of Habitat for Humanity of New York City and Westchester County. Many folks who have heard of Habitat or know a little bit about it think of Jimmy Carter and swinging a hammer in rural parts of the U.S. We are an affiliate of Habitat for Humanity International. There are separate affiliates throughout the United States and throughout the world, nearly 1,000 affiliates in the U.S., and in over 70 countries. Each affiliate operates a little bit differently. So some of the services I'll talk about today may not be offered at other Habitat affiliates in New Jersey, Long Island, or other places, but our affiliate has been building or creating new affordable housing within the 5 boroughs of New York City for almost 40 years. And 2 years ago, we added a 5th county, Westchester, to our service area. We mostly do new construction, but we do some got rehab of buildings. We do some single family homes, but mostly we create multifamily co-ops. And these could be 6-unit buildings all the way up to our largest development, I believe, was 56 units completed in the Bronx last year. In addition to our new affordable housing programs, we do have housing preservation programs. These programs were really started in earnest about almost 8-10 years ago. And there's 3 aspects to this. One is as a technical assistance provider, basically consulting services for multifamily housing, working with boards, setting budgets, working with management companies, navigating the DOB and Department of Finance. And then we also have a second leg of those services called construction preservation services. So we are a general contractor, and we can use our general contractor's license to create scopes of work, bid out on the physical repair or updating of buildings. And then the third leg of our preservation programs is where I come in, which is our Habitat NYC Community Fund, our CDFI. If we could switch to the second slide, please. So just a little bit of background on what a CDFI is. CDFI is a designation. We are certified and regulated by the U.S. Treasury Department, and CDFIs can be banks, can be credit unions, other types of lenders. We are not bank affiliated. We're what's called a revolving loan fund. So we borrow and then we lend, and our specific focus is on affordable housing. We lend throughout the state of New York, but most of our work is within the 5 boroughs of New York City. In general, we lend to income restricted multifamily buildings. But we can lend to all different types of housing. So you do not need to have a regulatory agreement or rent regulation or something like that to work with us. We work with naturally occurring affordable housing. We do some market rate lending. And then we can lend to also small landlords, rental properties, things like that. We offer financial products for the replacement or repair of building systems, implementation of green building projects, solar arrays, new boilers, HVAC installation. We can lend on the consolidation for the consolidation of municipal arrears or other outstanding debt. And our lending and where we're different from many other lenders is that we can be flexible. We can lend on both hard and soft costs. Right now, our term sheet would go up to $500,000. There can be exceptions. We have made loans larger than that, but in general, $500,000 or less. Our terms are generally up to 10 years, but we can go out 15 years. In terms of fees, we do have a standard application fee, $249. We're very fortunate. We currently receive pro bono legal assistance, so there are no borrower's fees for our legal costs, although you would have your own legal representation for reviewing loan documents and things like that. And then we do have a commitment fee in addition to our application fee. The commitment fee is depends on the product, but generally is 1% of the loan principal. We do have one loan product there it is 2%, but most of our loans are 1% of the total value of the loan. Like other lenders, the qualification process is an application, review of financial documentation, past year's financials and budgets. We also review any existing debt or liens on the building. But overall, we as a nonprofit CDFI, we try to be flexible in our terms and fit our loan products to what works best for the applicant, potential borrower. One of the things I do want to state very clearly today, we cannot make an offering or provide any specific terms, specific pricing or conditions without a full application review and loan approval. So when I turn it over to the next slide, I will be talking about a specific loan, specific pricing, things like that. But I just, this is for example purposes, and all pricing and terms are subject to review a complete application. And if we could switch to the third slide, please. So one of the loans that we made in our previous fiscal year, earlier this in calendar year 2023, was the first loan we made in partnership with the New York City Accelerator, working with a building Pinehurst House in Washington Heights. It was a $170,000 loan for a full boiler replacement, removal of an old number 2 oil boiler and a new fuel efficient boiler that is dual fuel, so also operates on natural gas. This loan is a 5-year loan with a 10-year amortization, and what that means is that there are fixed monthly payments of principal and interest. To give you an example, for this size loan, those monthly payments were just under $1,900 a month. And then there is a balloon payment at the maturity of 5 years. So that's what a 10-year amortization means. So there was a balloon payment, or will be a balloon payment, excuse me, of just under $100,000 at that maturity. Loan is prepayable at any time without penalty. In this case, we secured the loan with a lien. The building has an existing mortgage from a large bank. So we can take second position. One of the conditions of closing, we worked with that bank for their approval for us to add additional debt to the building. Other than that, I'll say, kind of typical of a lender, we ask for financial updates throughout the term of our loan. And otherwise, I think that's pretty much it. I will ask John Rivers on the call today, board president of Pinehurst House, to share a little bit about his experience.
Yes, good morning. I'm John Rivers, the board president, like Daniel said. Just a little bit of background. I don't know why my background was showing green, but anyways, what can you do? For over 8 months, our board was searching for financing through traditional banks, our bank that holds our mortgage, and for this boiler project. And we, without any luck, we could not find financing. We were introduced to the accelerator in August of 22. And we met with Andrew. When we first met with Andrew and his team, they got a good sense of what we were looking for. And within a very short period of time, Accelerator had set up probably 2 or 3 meetings with different lenders. And probably by the 4th lender, we met with Daniel and his group with Habitat. And I would have to say, after searching for over a year at this point, Habitat's process was extremely efficient, and their terms were something that the board could live with and present back to the owners of the co-op. During the whole process, Daniel and his team were very helpful, and especially dealing with our bank that holds our mortgage. We had a lot of challenges that held up our closing date, but we did finally work through all of the issues with the bank. And Daniel's team was very helpful with that. And I am happy to say that last month, our boiler was installed and right in time for the winter project, or this winter. So we are very happy. One, with the payments, we did put in, a 5-year assessment for paying for the boiler. So we are covered 100% on that. So if anybody has any questions of our challenges and things that we went through, feel free to reach out.
John, thank you for those kind words. As Andrew mentioned, we'll be taking questions at the end, either about this specific loan or programs, and then also, as we've mentioned, we're a preferred capital provider, so Andrew and his team are always able to get in touch with us if you have any questions or would like to be connected. Thank you.
Thank you, Dan and John. Thanks very much. That was great overview. So our next speaker I'll introduce is Ross Radia, who is a managing partner at LED.Finance. LED is an equipment lender, and Ross focuses on energy efficiency equipment projects. And he will discuss his lending platform and the case study. In this case, the loan, or the lease, actually, it was done as a lease, was for a tenant of a commercial building. So we weren't able to get them to join us. So Ross will cover the case study. Thank you.
Thanks, Andrew. Good morning, everyone. I'm Ross Radia with LED.Finance, and first I'd like to thank Andrew and the team at New York City Accelerator for allowing us to participate in the program and also to be panelists to present a case study here on a deal that we closed just recently. And this is, as Andrew mentioned, our approach to financing building improvement projects, primarily energy related, is in our equipment leasing or equipment finance model, which we're secured by the equipment that's being installed, as opposed to, a mortgage or lien on the building or anything like that. So in this particular case, we had a customer referred to us who was moving. It's a manufacturer that's moving into a larger facility in Brooklyn, and their lease agreement with the building owner had no provision for tenant improvement budgets. So they have special HVAC needs because they're a manufacturer of products that just require additional ventilation and heating and cooling. There's also a provision in their lease agreement for the location to comply with local law 97, and they had all of the responsibility for any HVAC improvements. So this is a closely held business. By that I mean it privately owned, 3 individual owners, and we categorize it as a small business. So it's revenues under 10 million and closely held. So the project was for the HVAC improvements that they needed for this particular 13,500 square foot space that they're moving into. And our goal is always to provide 100% turnkey financing, all costs included in the financing, any fees, hard costs of the equipment. Soft costs can include, from our perspective, labor, engineering, electrical, and other soft costs. And in this particular case, we typically like to limit that to 50% hard costs versus 50% soft costs. In this case, there was a little bit more soft costs, but understandable based on the customer's needs. There was some extensive ductwork that was needed for ventilation. So the solution that we brought to the table was a fully amortized equipment lease. And when I say lease, these are leases that are intended for customer ownership. So there's a stream of payments with a fixed purchase. It could be $1. It could be any other dollar amount. It could even be fair market value, depending on what the customer's needs are. In this case, the tenant customer's lease on the space is a 5-year term. So that's what they wanted, was a 5-year term. Our typical terms are anywhere from 2 to 10 years, but 5 years is a good fit in this case. And the all-in APR is 12.19%, and that's inclusive of all underwriting costs. In other words, the customer has zero out-of-pocket cost, and I'll share the term sheet on this, as we're required to provide APR disclosure for any deal that we do in the state of New York. I think the most interesting part of this is keep in mind that we're secured only by a UCC1 on the equipment itself. In other words, we're not putting a lien on the building. We're not encumbering the property in any way. And in this particular case, with a small, closely held business, we did require the personal guarantees of the owners, which they had no problem with. I think from our perspective, one of the key factors in this was our ability to negotiate with the building owner's attorney a subordination and consent agreement, acknowledging that we're financing this HVAC system in this building. And that was probably the longest piece of the underwriting process, was having our legal team negotiate with the building owner's attorney, which we did successfully, and everyone was happy. So that was an important piece of this. The other interesting aspect is that the mechanical contractor in this case is also a small, closely held Brooklyn-based contractor who does mostly residential and some light commercial. This was their first commercial financing. So there was a bit of a learning curve for them on this, and we basically held hands with the contractor and the customer and got everybody to the finish line, and we were able to structure this particular financing, meeting their progress payment milestones, which are listed there: 40% on signing, 30% on equipment order, 20% when the equipment was arrived on location and was ready for install, and then a 10% holdback once project's completed. Customer signs off on it. We'll fund that last 10% to the contractor. So, Andrew, we can go to the next slide. So this is our standard rate disclosure that's required by law in the state of New York. It's very self-explanatory, very plain English. It tells exactly what the finance charges are, what the total payments, and then the payment terms. This particular customer asked for a balloon payment equal to approximately 30% of the overall project cost, which we were able to incorporate into this over a 60-month term. And I will share that, our rates are going to range anywhere from prime +1 to prime +3, because we're only secured by the equipment in the deal. In this case, we were at the upper end of that, but it was also, as I say, it's all inclusive. There was no out-of-pocket costs for the customer. And so I always frame it up with our customers, comparing interest rates. So Andrew, if we can go to the next slide. I always try to present how does this financing compare with a small business administration guaranteed loan? And these are the current rates for SBA loans. And in addition to, and that of course is the maximum interest rate. It could be less than that. but I highlighted the area that we were in on this deal, and we were at 12.19. Could have, in an SBA situation, it could have been as high as 14.5. However, that rate does not include the underwriting fees that can be charged of 2 to 3% for a small business administration guaranteed loan. So try to give some sort of comparison to get the customer comfortable that they're not paying too much for this financing, because again, we're not real estate secured. We don't have any lien interest in the actual property. So I hope that kind of frames it up for everyone as far as what the current equipment leasing and financing rates are. That's industry wide, is typically in that prime plus to prime plus 3, somewhere around in there. And so again, I just want to thank the New York City Accelerator team for allowing us to participate. It's a lot of fun for us. We really enjoy working with the customers, and my bio is attached if anyone wants to review that. I've obviously been in the business a long time, and I plan to continue to stay in the business for a long time. So thanks again.
And thank you, Ross. It was a great overview. I'm going to introduce our next speaker, which is Jay Mervis from the New York City Energy Efficiency Corporation, also known as NYCEEC. And Jay's going to be discussing their first closing of a new product called Multifamily Express Green, or MEG loan. And this is something that they developed to meet the market, and it is very tuned into the market need. It's only for co-ops and condos doing in New York City, doing small to mid-sized decarbonization projects. And also with Jay will be Toby Johnson, who represents the building owner that took out this loan. So I'll hand it over to you, Jay.
Yeah, thank you, Andrew. Good morning, everyone. I noticed, Andrew, that on your first slide you had a picture of Midtown Manhattan, also, and just I think the survey said there were over 50% of the listeners today were building owners. But don't worry, your building doesn't have to be a big building in Midtown Manhattan. So NYCEEC works with buildings of all sizes and all shapes and uses, and we'll get into that. A little bit of background first on NYCEEC to ground everyone. And you can move to the next slide. There we go. Okay. Yeah. So we are focused as a mission-based lender, a green bank. A local green bank on projects that advance the environmental goals of the communities that we work in. Years ago, I used to say that we work on projects that save energy or reduce greenhouse gas emissions, and that's still basically true. But when you think about it, there are things out there like battery storage, for instance, that really doesn't save energy, that actually uses energy, but it's part of the mix of where we all need to get to down the road. We just also did our first EV charging transaction, and that per se isn't saving energy. It's shifting the mix of energy from obviously fossil fuel to electricity. And it's important to us that clean energy and a green building environment be accessible to all. We take that very seriously. We work in all sectors, market rate, residential, affordable residential. I think last count over the last 3 years, about 80% of the buildings that we financed were in disadvantaged communities or part of the affordable housing sector. We also do, a lot of work in non-residential as well, commercial, industrial, institutional, higher education, healthcare, all of those sectors. So we're going to speak today, as Andrew mentioned, on a very, very specific product, with one project highlighted. But please know that NYCEEC is available. We have lots of different product offerings, some of which are going to be highlighted in future sessions that the Accelerator financing team is going to run. And hopefully you'll be able to join those and learn more about those in those sessions. And certainly you're available to reach out to NYCEEC at any time to learn more about what we do. You can go to the next slide, Andrew. Okay. Yeah, one more point wanted to make, and I saw one of the earlier speakers mentioned Westchester County. We do operate in what amounts to a 9-state service territory, and we are active in those states. We're just about to even close our first transaction in Rhode Island. See that tiny little state up there. But been very active in Westchester County as well. So we're going to discuss the MEG loan. That applies, as Andrew mentioned, really focused on co-ops and condos. And I'll tell you the modifications that we can make as we get into it for some other situations. But those co-ops and condos don't necessarily have to be located in New York City. They can be otherwise. You're a contractor, service provider, and you've got customers in Westchester, New Jersey, wherever in this service territory. Please know that you can reach out to us. And we can be helpful in those markets as well. Next slide. Okay, so this is what we're here to talk about. We call it the MEG loan, as Andrew mentioned, the Multifamily Express Green Loan. And what we learned over our years, and we've been making loans since about 2012, 2013. What we learned over the years is looking at cooperatives, looking at condominiums, looking at their needs, looking at the way they organize themselves, their financial statements and those sorts of things, that there's, as probably no surprise to anybody on the call, a great deal of similarity across the board in terms of what I just described and how they're run and how they present their information. So it really became apparent that a more streamlined approach to working with those organizations, those buildings, would be very, very helpful for the market, and that's what really drove this approach. And we can get there, from application to loan closing in as little as 6 weeks. Depending on mostly, how quickly you as the building owner borrower want to move, and how quickly we can get some of the other, maybe what I'll call third-party aspects of the transaction done, which I'll get to in a second. Very important to note that virtually all green measures are acceptable for the MEG loan. As I kind of loaded, like in the last bullet, you can say here in New York City, of course, we have Local Law 97 and those things that comply, that help you comply with Local Law 97. Those will all be looked at seriously and evaluated. We do, to be fair, we do try to focus on moving buildings away from fossil fuels. I know that's been a topic in the news for the past week or so, as well, fossil fuels. So I'm not going to, if you have a project that continues to use fossil fuels, you can show it to us. We are going to inquire as to whether non-fossil fuel or more likely electric type options were evaluated, and really want to understand that. So I don't want to discourage anyone from reaching out to us. Please do, but I also want to be fair, and I think it's pretty clear that the city and the state and quite frankly the country, right, really wants to, at some reasonable pace, move away from fossil fuels, and NYCEEC wants to be part of that. The application, the product itself, we have a very streamlined application, really just asking for some basic information, financial statements, for if you're a cooperative, existing mortgage, what is it? Send us a statement, an acknowledgement that you're up to date on your taxes and water and sewer charges and those sorts of things, and a description of what you want to do. That's really about it. We will cover up to 90% of the eligible project cost. If you are in a disadvantaged community or in an affordable housing situation, and it's important to try to go higher than that 90%, we will try. But that's really a benchmark, and certainly that's what you should be thinking in terms of the market rate sector. Loans $200,000. This product we can do a little bit smaller. As a matter of fact, the situation that Toby's going to talk about is a little bit smaller. We just found that that's a good stake in the ground. If your project's a little bit smaller, please show it to us. We probably will be able to get there. And this product probably goes up to about $700,000, $800,000, or $900,000. If you have a bigger transaction than that, please show it to us. But it probably will take, to be fair, when we're talking about $1 million plus loans, there is more involved. And it will take a little longer than 6 weeks, and there will be some additional fees. But let's stay focused on these. I think the vast majority of projects are under that $700,000, $800,000, $900,000 range, and really applicable here. Our interest rate is 7%, but good news, if you come to us through Andrew and his team and the accelerator, we reduced that rate down to 6.5%, 1% closing fee, and a flat $2,500 legal fee. We have a very streamlined, as I mentioned before, loan document. It's basically 6 pages. Yes, there's 20-some pages behind it of sort of the standard stuff. You will, abide by all laws and things like that. But really 6 pages that you and your lawyer would really going to want to focus on. Like I said, everything's streamlined. The loan term is 10 years of amortization, plus we allow for a construction period. During that construction period, you'll be paying only interest on the amount you've drawn. So there's no unused fee. There's nothing like that. When the project is done, now you're enjoying the project, if you will, then you'll pay us in 120 equal installments over that 10-year period, and you'll be paid off. No balloon, no lump payment or anything like that at the end. And 2 very important things: fully prepayable without penalty. We're a mission-based lender. If you prepay us, we'll take that money and we'll put it into the next project and advance the greening of the building stock. So really very low risk on your part. 1 year, 2 year, 3 years, some better financing opportunity comes along, or you've got some other reason to consolidate loans, no issue. And then no energy audit required. I mean, we want to focus on helping you get your specific project done, and be the financing source for that. Next slide, Andrew. Okay, so I'm going to turn it to Toby. By the way, here very important. I told the team, I said, we've got to find a picture of leafy Brooklyn, and that's what we've got here. We did a project with Toby and his building on Sterling Place, an electrification project. Again, also working with Andrew and the accelerator team, and I'll turn it over to Toby to give a few words about the project.
Hi, yeah, we're a very small co-op in Park Slope. We're just 4 units, so we're all on the board. And we're generally the kind of building that just floats along, and we're self-managed, and we just kind of repair things as they break. And what happened with us is after we got our local law 152 gas inspection, we basically realized that for various reasons, our gas infrastructure was a mess, and that the smartest thing to do is just to get rid of it. So we decided we'd try to replace our gas boiler, and gas hot water heater and get electric heat pumps. And we couldn't find any sort of financing anywhere. We don't have an underlying mortgage. And when we thought, okay, we'll just get one, we discovered that nobody seems to want to issue mortgages to little tiny co-ops anymore. And we were told that it just wasn't profitable for the banks to do it, and they just didn't bother. And so we couldn't find anything. We didn't really feel like the only option that we heard about was like an owner in the building lending money to the co-op, which we definitely did not want to do. And then eventually we found NYCEEC, and we were able to move ahead with our project. So as Jay was saying, it was a little bit smaller than it was, so an $120,000 loan, which let us upgrade our building to electricity, install electric heat pumps. 3 of them are ductless, and then the one on the first floor is ducted because they were able to put some stuff in the basement to make that happen. And also covered plumbing to replace our hot water heater with like an efficient electric boiler that has a heat pump attached to it. So we also got $12,000 in Con Ed clean heat incentives, which was helpful. And then there's also like individual incentives that will go to us as tax credits under the Inflation Reduction Act. So that should, assuming I understood everything correctly, it should be $2,600 for each unit. Yeah, so that's what I have to say.
Thanks, Toby. Appreciate it. And it was a pleasure working with Toby and the other folks at his co-op in Sterling Place. Andrew, do you want to move to the next? I think there's one more slide. Yep, there you go. Good. It says thank you. Yeah, so just a couple of comments. If you do have a rental building, we can basically modify this a little bit. We obviously have a standard application. It's going to ask for a little bit more information, rent rolls, and those sorts of things. But we can basically work with you under very, very similar economic terms. It will be there are some additional costs. I want to be fair, but please, we do lots of rental buildings as well. And the other thing I want to mention, to those working with co-ops and condominiums, take a moment. I think some of the other speakers mentioned, take a moment if you can and do 2 things. One, take a look at your bylaws to remind yourselves what permissions are going to be needed to enter into a loan agreement. Can the board just do it? And a loan agreement of a certain size, right? So can it be done just at the board level? Do you need a vote of the shareholders or unit owners? And if so, what percentage have to vote yes? And plan for that. And we can help you educate the board members and the unit owners as well. And also for co-op situations out there or rentals, really, do you have an existing mortgage? And if so, do you require consent? Again, as someone mentioned earlier, we don't take a lien on the building property itself, just on the equipment that we're financing. That might help with, that might alleviate the need for a consent. It might not. So, try to understand that. And again, we'll work with you to understand that and to get those consents if required. But to be fair, that's probably the number one source of delay in getting these transactions done, is the requirement for consent if it exists. And finally, I just want to say our email is greenloans@nyceec.com. If you forget anything or everything that I've said, that's totally fine. As long as you remember, you can email us at greenloans@NYCEEC, NYCEEC.com. We'll get back to you right away and start understanding what you want to do and move forward from there. Thank you.
Great. Thank you, Jay and Toby. It's a great presentation. I think that wraps it up for our presentations. I think the last slide here is just some contact information for the accelerator. I noted earlier that if you are a lender out there listening in and would like to respond to our capital provider RFQ, that email is in here as well as just contacting the accelerator for general services, technical services. So with that, we're done with our presentations, and I think I'll hand it over to Laura. I see there's quite a few questions coming in, and Laura can read those off and to the panel.
Yes, thank you so much for a wonderful presentation and a wonderful set of questions. So my first questions are to Daniel and John. There are several folks who were interested in learning more about how long it takes for the application and closing for this process, and if you can speak to not perhaps a specific interest rate, but what is the typical range? And on that project, people were curious about if the boiler was gas or electric, and did you consider the estimated energy savings and the payback in that decision? So those two are for Daniel and John.
Thank you. I'll start. The time frame can vary. In this case, because there was an existing mortgage on the building, I think that was probably the biggest hurdle to get us to a closing. We endeavor from moment of application to credit decision to be 90 days. Sometimes that is a little bit longer, depending on how complex the building is, things like that. But it's often the biggest hurdle to closing is working with other lenders or other organizations that may have a lien or an interest in the building. So in that case, that took some time. Our pricing has generally been around 6%. We've recently had an increase in our rates. So new applicants, we're talking about 6.5, potentially 7. We are a nonprofit. We do require 200 basis points over our cost of capital, but our goal is to keep the cost of capital as low as possible. In our underwriting, we did not consider energy savings at a specific amount, meaning the project produce energy savings or reduced carbon emissions. And so for us, that was enough to go ahead, but we don't have specific benchmarks or things like that for energy savings. There were a couple other aspects to that question. I forget. I know one specifically would be for John about how they did the conversion from oil to gas as opposed to electric. I forget if there was another piece that could have been for me.
No, that was great. So the boiler, was it a conversion to gas or to electric?
No, we kept it as oil at the moment. To convert to gas, it would have been another $50,000 to $75,000 for the conversion and updating our stack. So we decided at this time we would just stay with the oil.
Thank you. Thank you. And the next question is for Ross. Ross, can you explain a little bit more about the financial terms and how they change between an equipment lease and an equipment loan?
Sure. I think the biggest difference is in an equipment lease, again, secured only by the equipment via what's called a UCC1 filing on the equipment. So no other collateral or lien filings outside of that. And they're designed to have a specific purchase at the end of the term. Like I say, it could be $1, could be any fixed purchase amount. It could also be a fair market value, depending on what the asset is. Comparing that, I think the biggest difference in comparing that to a variety of loan products, if it's a simple interest loan product, it's usually secured by a second or lien filing on the real property. It can also have other payoff terms. In other words, it could have principal only plus a certain portion of the interest as a penalty. But again, in a lease, the lessor has right title and interest and ownership in the equipment until the end of term, at which time that the ownership transfers to the lessee at the end of the term. In a loan, the lender has a security interest, probably in the equipment, perhaps in other assets, and the customer is the beneficial owner of the equipment during the term. There's probably a lot of other differences, but those are the major differences. And in my world, we use a document. If we're doing a commercial finance agreement or an equipment finance agreement, the customer owns the equipment, the lender has a security interest in the equipment, and there is no buyout at the end. So we do a healthy balance of both finance agreements and lease agreements. In our case study, the reason that was done as a lease is that's what the customer's preference was based on tax treatment and the way they wanted the lease structured. So frankly, we probably do more finance agreements than we do leases. So hope that answers your question, Laura.
Thank you. And can you just comment about how your interest rate might compare with market rate and the benefits of an equipment lease or loan?
Sure. Let's define market rate. So the prime lending rate right now is 8.5%. Okay. That is the rate that banks are going to give their best customers, right, that qualify for the prime lending rate. So for us, I mean, there are situations where we have either a municipal or some other type of a school, for example, that we do where, you know, it could be in the 6 to 8% range. But in the commercial equipment leasing industry, especially in the deal size that we're talking about that we profiled today was $200,000 lease. So our rate on that deal was prime plus what, 3.5, but all costs were included in that. Pardon me. So when we talk about market rate, we're not talking, if in my field, right, which is equipment leasing, we're not talking about mortgage interest rate. We're not talking about mission-oriented lending, nonprofits that exist to support, you know, multifamilies like our presenters today. Those are mission-oriented lenders and are nonprofit agencies. So in what we do, it's all for profit. It's fully taxable. So there's a lot more that meets the eye. That's why I kind of balanced it against what the current Small Business Administration loan guarantee rate limits were, to let you know that the market at say 8.5 to 11.5, 12%, that's current market rate for equipment leases and equipment finance agreements. I hope that helps.
Yes, thank you so much.
Well, Laura, the other part of that is the risk. You know, rates are always relative to risk. And in what we profiled today, we had a tenant occupied space. We don't have the building owner as a borrower or a lessee. We have a small business that's closely held. We have 50% soft costs in the deal. So not that they're a bad credit, it's just that that's where the risk ratings came out. So rate is always relative to the risk rating in a deal. So just wanted to throw that in there.
Thank you so much, Ross. So this is a question for Jay with the NYCEEC MEG loan. Can you confirm that this is available for both co-ops and condos? And there's a few questions here. Do you need consent from a mortgage lender? And what's the maximum that you could lend through the MEG loan, and that can that be stacked with another loan from NYCEEC?
Got it. Okay. So a couple things. Yeah, the MEG loan is designed, the M is for multifamily, and that part of multifamily is both condominiums and co-ops. So that is a very, very straightforward yes. I think in terms of thinking about the MEG loan, you mentioned about size limits. I would think about it in terms of having $1 million project, which probably is going to translate into a loan, a maximum loan size of about $900,000. So we do larger transactions. We do transactions. We have lending partners. I mean, you could bring us transactions, I'd say up to $8-9 million, and we can get them done. But you know, we've got to be realistic. As I mentioned, loans over $1 million are going to require more diligence, more legal work. It's not going to be 6 pages, so there'll just be a different kind of cost structure associated with that. But we very much want to do those transactions. When you say, can it be stacked? I think the quick answer to that is yes. I mean, we would look at the credit analysis of that transaction, factoring in whatever loan already exists. And obviously, you know, depending on the cost savings associated with the new project, the overall financial position of the building in question, we'd be able to approve or not approve, or say approve a certain loan size. Did I get all of them?
Yeah, and just if you could speak more, a little bit more about the mortgage lender.
Oh, mortgage consent. Yes. Okay.
Yeah,
so
yeah.
that's
Just to explain that a little bit. Thank you.
Sure. That's a very idiosyncratic question, in that it depends. There's two things. One is that we're not taking a mortgage lien on the building that the cooperative's building. So that may help the answer being no. The answer to that question is in the mortgage document that you have. But the ways to get to no: one, we're not taking a mortgage on the property. And two, what is the size loan that you require consent for? So I've seen different numbers. I've seen 500,000, I've seen 250,000. Obviously, it depends upon the size of your building and the size of your mortgage, most likely. But most of the mortgages will allow you to take a loan without their consent as long as it's under a given size. And we'll help you sort that if you can, if you contact us, we'll help you take a look at the mortgage and where that consent provision might be and sort that out. It might make sense to maybe do a slightly smaller project if you don't need consent. We don't necessarily want to do that if it doesn't save as much energy as the bigger project, but we'll help you get to your specific answer to that question.
And Jay, I have a follow-up also. Can borrowers use grants and incentives to cover that 10% that's required? How are those things considered in this loan?
Yeah, that depends. I mean, a fair answer, excuse me, is the more, if your building is in a disadvantaged community, or if it's part of an affordable housing structure, then it's more easy for me to say yes. In more of a market rate context, I'm going to say it depends. I think we do want to understand that the the building owner has some economic interest, you know, in the project from the get-go. Not unlike, you know, getting a car loan. Usually you don't get 100% financing, or when if you buy a single family home, you know, usually not 100% financing. But that you know, I would say that's a partial. Yeah, probably not covering that full 100% of the difference between the loan and the project cost.
Thank you so much. We did have some questions for Daniel about lending. So the project increased the efficiency of the boiler system at Pinehurst. So do you give out loans for efficiency improvements? And how does that play into whether it's a gas or an electric project? Is there different considerations for that, or is increasing the efficiency more of the focus of your program, serving affordable and naturally affordable communities?
I'll say increased efficiency is more of the focus. Most of our lending is to income restricted buildings. So in those cases, there doesn't necessarily need to be an energy efficiency component, although most of our lending is. But beyond the income restricted or rent regulator, things like that, we also look at location. So part of being a CDFI and maintaining our certification is lending in not necessarily low income areas, although that is often synonymous with areas of low investment, or where there are other lack of banking services. So that's our primary work, is providing financing in areas that lack it. It just so happens that energy efficiency is most often a component of what we are financing.
Great, thank you for that clarification. Ross, we have a question. Can heat pumps be part of an equipment lease?
Yes, I failed to mention that we're technology or equipment agnostic. In other words, we've done electrical panel upgrades, certainly heat pumps, anything, lighting, HVAC, solar. We've done combined heat power. You know, there's no restriction. Had a couple of challenges with elevators. We can do elevator upgrades, but not the full kind of build out. Yeah, so certainly heat pumps are easy for us to do. Yes.
And can you, Ross, can you give us an example as energy as a service?
Yeah, I think the key thing to remember with anything as a service is it's a third-party ownership model. In other words, the building owner does not own the equipment. It is owned, operated, and maintained by a third party. The reason that a lot of folks do that is if they have certain restrictions like borrowing covenants, or they're unable to qualify for or get the project qualified for the type of financing that is not accounted for on their balance sheet. They're looking for something that gives them the accounting provisions that they need. So the key part is third-party ownership that operates and maintains the equipment for a specific benefit to the customer. Typically, if you think about lighting or HVAC or those type of projects, it's a savings scenario where the cost is covered in most cases by the energy savings in the deal. And the terms on those can sometimes be longer than traditional equipment leases and loans. We regularly see those 10 and 15-year type terms, and a lot of that is because if you need the project to pay for itself, the term in some cases need to be longer. But usually when we see those, it's folks that are trying to meet accounting guidance and keep that, make it not a borrowing that hits their liabilities on their balance sheet. So happy to answer any other specific questions, but that's generally what it is.
Thank you so much. Thank you. So I have a question really for all three lenders. Can you help with loans for the rehabilitation of the property, not just energy upgrades? Is that something you're considering? And can you just speak to that very quickly? If we could start off with Daniel?
Yes. The answer is yes, we do loans to rehab. We don't currently do loans to individuals. So if you own a condo, as a condo owner and looking to rehab things in your unit, but we would lend to the condo itself for common areas, larger systems, or in the case of co-op, something similar. We could lend to a vacant unit that's owned by the condo or co-op that needs to be rehabbed before sale, but we wouldn't do a loan to an individual for rehab.
Okay. Thank you. Thank you. And Jay, can you speak to that also?
Yeah, we're probably not the best choice. I mean, I will say that if there are, what we call ancillary or incidental costs. So for instance, we've done solar deals where maybe 25, 30, 40% of the cost is upgrading the roof. So you want the roof to be in tip-top shape before you put in solar panels that are going to sit there for 25 years. So things like that are okay. But if the heart of the project is really a real rehabilitation of a building, and the energy attributes, environmental attributes are secondary, then we're not really the best choice there. So it depends. We're always happy to take a look and give you quick feedback.
Okay, and we just have a moment. We just wanted to let you know we had a lot of questions and we can't get to all of them during this presentation. But we will send you a follow-up and answer any questions that you've submitted to the program. And I want to thank everyone for attending and thank all of our panelists for participating. So we have just time for one more question, and I think that would be to Jay. Can you give us examples of a successful MEG loan or ones that are in the works that the mortgage lender has given consent? Is that something that you're seeing? I guess people have additional questions about that.
Yeah, no, that's the biggest challenge, and the answer is yes, we have gotten consent to from mortgage lenders. The problem is that they're not blanket consents. I mean, it's either due to a loan size, or it's either, quite frankly, due to some borrower positioning. Meaning that that's a really good borrower, the bank doesn't want to say no to their borrower, and and then when it comes time to refi, or what have you. But that's why we say kind of get to it early, and start working on it right away. So especially if you're the bank feels they're coming at the end, or they're feeling rushed or whatever, that's not going to make it well. But consent is obtainable, but it's not a cakewalk.
Thank you so much, and I want to thank everyone for participating. This particular program was focused on financing, not necessarily incentives. I would encourage you to contact the New York City Accelerator. Our contact information is on the slide. You'll receive a dedicated account manager who will navigate those incentive programs with you, the ones that are applicable for your building type and for the project scope. So please do contact the accelerator and we'll review that information with you.
Yeah, I just want to reiterate what Laura just said. I just really want to thank all of the panelists. It was a really great presentation and overview of these products and case studies. I think it was really helpful and a lot of good information. And thank you also to all of the big crowd of participants that joined us and stuck with it until the end. Thank you.
Thank you, everyone.